All right, welcome to the Multifamily Naked Truths. Today I have a special guest. I have Thomas Beyer. He's out of the Sunshine Coast this afternoon. Hello, Thomas, and welcome.
Hey, Corey, thanks for having me today.
Yeah, anytime. So, yeah, we were just talking about a little bit of German heritage and a little bit of our family backgrounds. Aus Deutsch. So, those of you who don't know Thomas, Thomas actually came to Canada. English is not his primary language. If you haven't, his first language, if you haven't picked up on that already, but you will shortly. But so tell us about. Well, let's just start with how did you come to Canada? How did you first? You came as an exchange student, but what made you decide to immigrate? How did you end up here?
Um, I I went to school and studied computing science in the early 80s. And in the early 80s, there was a lot of computing euphoria, let's call it, because Bill Gates and Steve Jobs exploded onto the scene with their PCs and Macs, right? And there was a huge demand worldwide for software engineers. And I realized, because I had worked, several times in several companies in the Munich area, that there's always jobs out there, and it's easy to find jobs. So there's no real rush to rush into the workforce. And I always had a bit of a sense of adventure. I wanted to study either in the US or in Canada, and so I applied for scholarships, and I ended up getting a scholarship in Edmonton. And it was a blank scholarship. I could have done anything I wanted, so I did an MBA because I had a bit of a bent for business, not just the techie stuff, like many of my techie colleagues who also went often into video gaming and played games all night long. I never did that actually. They had this ping pong game. You remember that first video game where you can send that ball back and forth?
Yeah, Pong.
And then of course it got more sophisticated as the computer graphics got more advanced in the 80s. But I never was sort of into that techie stuff, but I like the business angle. And while I was in Edmonton, I met my now wife. And after dating hot and heavy for about a year, I had to go back to Germany because my student visa has expired. So she said, "Look, I'm not going back to Germany with you as your girlfriend. So we either cut it off right now, or we get married. So pick one,
That's great. I've heard the story before. I've known you for almost 20 years. I first met Thomas in 2004, basically from an ad he was raising money for one of his joint venture deals. And at the time, I was living in Central Asia. I was living in the Kyrgyz Republic. I was very new to real estate. I'd done some single family deals, didn't know anything about multi, and I thought, this is a perfect guy to go in it with. So that's how we started our relationship. So I take it when you came to Canada, I think you didn't exactly have tons of money in your pocket when you first came.
Oh, no,
it was a bit rough at the start, wasn't it?
Yeah, I mean, I was in my 20s, so I had less than $1,000 in my jeans, and I couldn't spell the word real estate, let alone in English. So, because I always was a renter and never grew up, with wealth, or I never lived in a house with my parents. I have shared a room with my brother, and so the idea of owning a house was certainly maybe a goal, but I never owned one. And then the first few years we were renting, we had no money, but I took a course while I was working after my MBA. I was working, and I met a lady in Vancouver, in Burnaby, and she was of Asian descent from Hong Kong, I believe. And we was talking, and she said, "Oh yeah, we own 10 houses in the Burnaby area." And that was 86, 87, just when the Hong Kong crisis started first, when it was reverting back from the British Empire to China. And a lot of money had left, was leaving Hong Kong, and a lot of money, as we all know now, came to Vancouver, and so prices were exploding. And you saw the same headlines you saw today, 25 years later, like real estate bubble can't continue. Who can afford a bungalow in Burnaby for $250,000? Like, who's that? Like, who can afford that? Price to earnings ratio, blah blah blah. And so that lady, I realized, all these houses went up from about 150 to about 250. So she owns 10 houses. Or she made $1 million. Like what does she know that I don't? That was sort of triggered my initial interest. And then we moved to Munich for 2.5 years, and I was worked with IBM there. But all of a sudden realized, guess what? In Munich too, there's a lot of real estate, right? You walk around, and every street you walk around, there's buildings, right?
Yeah.
And it occurred to me, I was then maybe 30. Every building on the street is owned by someone. It never even occurred to me before that every building is owned by someone. It's either a pension fund, or it's a government, or it's private individuals, or it's groups, or it's publicly traded companies. That idea that actually someone owns real estate and then rents out the space was completely foreign to me until then, right? And then, of course, once you have an awareness, then you try to educate yourself. You move back to Toronto. I worked for IBM in Toronto, and then I took a course with Raymond Aaron, and he had a weekend course for $99. I teach you how to become a millionaire, with real estate. I said, well, I don't quite believe all that, but for $99, why not, right? Took a 2-day course, and he actually taught quite a few useful principles. Basically, his concept was based on townhouses. You buy an old ugly townhouse, you rent it out for, maybe it's worth 100,000, you rent it out, and then you sell it for 130, 140,000 bucks a few years later and collect the rent and multiply it. That was sort of his concept then. And that concept still works, although today I think it's a bit more difficult, given that the prices have escalated far faster than rents.
Totally. I mean, I was very much like yourself. I got started very late, had a very late awareness. I kind of grew up on a farm. I rented for a long time too. I was in my late 20s before I started too. But I just want to kind of fast forward to today. So when this book was written, I think back in 2013, it was 80 lessons, 80,000 to 80 million. So this was referring to your first condo for $80,000. And I remember you wrote a little note in here for me when I went to visit you. Say, Corey, may even a smart guy like you learn a thing or 8 in here to your success. So this was fantastic. November 2014. Now I just looked at your track record today and just looking at some of the numbers. So I want to just look at where we are today, and then we're going to look at some the journey of how you got there. And my audience will have a lot of these questions for you, and I'm going to ask many, some of the tough questions too. It's not always a smooth road. We've had a lot of rough patches on the way, but just looking at the track record now, you've now got 41 projects. Now, tell me if this is right. 2,191 units. 128,247,000 in purchased for a valuation. It looks like around 180 million between selling price and the ones you still own. And then your track record before says financing management of over 225 million. So all that from an $80,000 condo in, what are we looking at, 22 years now?
Yeah, I mean, obviously, you don't start with big buildings unless you inherit a lot of money, which of course some people do, right? That wasn't me, but there's people who inherit, perhaps their parents died or their grandmother gave them $1 million. That's not uncommon issue today, right? Yeah. If you don't have that, you got to start small, and small is usually either a small house or a townhouse or a condo. And so I want to hear about. Sorry. So my first property was a condo in Calgary, and then a condo in Phoenix, and a condo in Edmonton. And they all were rental pooled, and with a company called IPG, or then 2020. I still own that Edmonton condo, actually, to this day, 22 years later, I still own it, because it's rental pooled. And then you sit on it, you collect the rent, you get your monthly check, you pay your mortgage, and you usually pay a mortgage down, and usually the value goes up. Now, it's not always a smooth, straight ride. I mean, the Calgary condo I bought for 80, I sold for, I think, 140. 150. That was 15 years ago, a long time ago. Today, probably it's worth 200-ish. I just sold one in Kelowna. I bought for 80. I sold it for 230, right? So as you know, we live in Kelowna. Kelowna had a fantastic ride. Now, if you buy a condo today, you might not get this spectacular upside anymore. It all takes a bit longer, right? But you certainly get your mortgage paid down, because one of the good things about real estate, or income-producing real estate, is that what you don't know is what the value will be in 5 years or 10 years. What you do know, though, is that your mortgage is lower. Yeah. So out of those three pieces, I know you've referred to this as the 3-course meal, right? One of those courses is the pay down, because that's the one thing on paper you can go back and, as long as you have a fixed rate mortgage, you can go back to your investors and say, look, even if the market's flat, even if we don't get any appreciation or we break even on cash flow, we can at least deliver this amount, right? Correct. And then, of course, you have times, and I got caught, like many other people, where we owned assets in Alberta in 2015, and then, of course, there was a massive correction from 2015 to probably about 2020. Last 2 years, we've seen some modest upside again, more so in Calgary than in Edmonton, but we're seeing now tighter rents and lower vacancies and value upside again. But of course, now we went through. So we'll see. So the market doesn't go up in a straight line; it goes up in bumps. But you look at any real estate anywhere on the planet, in any city, be it Egypt or be it Ecuador, or be it Madrid in Spain, and anywhere, prices today are higher than they were 20 years ago, right?
Yeah,
So, and in
I
many
want to
cases, a
talk.
lot higher. Not
Yeah,
necessarily
and I
higher
want to,
than not necessarily
and I want
higher
to talk
than
about
a
that
year or two
period
ago.
too.
But
Yeah, that's a great point there. So I want to hear about the first multifamily deal. So it was 2000. It was I believe it was a 15 suiter. You bought you had some money with your father, and you went in. You signed that first personal guarantee for that $500,000 mortgage. What was that like? The stress level. So many people that are watching this, they want to buy their first multi, but they're just to get to that step. I mean, did you lose sleep over it? What was that like?
well, as I said in my book, I mean, the first three condos were all around 80,000, right? And then I realized, what? I was wondering how much would you pay per unit if you buy a small building? Well, guess what?
Yeah.
In Edmonton at that time, an average building was about 35 to 45,000 a unit, right? So you buy 15 units, I paid $570,000 for 15 units, which was an average price. It was nothing special. It's not that like you got a special deal. I didn't really know the market all that well. But I realized there's many buildings for sale, all in the 30s a door, right? And the rent is somewhat similar to this condo, like $600-700 a month.
Yeah.
So it probably makes sense to buy the whole building, not just one condo. But of course, you need more money to buy a bigger building. And I developed a big spreadsheet to realize, what is the potential upside here? Because the Edmonton in the year 2000 was oil sands boom town, because a lot of the pre-staging and hiring happened in Edmonton. Oil was going up, there's lots of hiring, and values were going up. So all these properties today are probably worth in the low hundreds a door, right? 100 to 120, depending on location and quality.
Yeah.
And then I realized, ideally I get a CMHC mortgage, and ideally I put down only 15%, and I get an 85% mortgage. So on a $570,000 deal, that's about 70, 80 grand cash, plus some holding costs, and the rest is mortgaged. And then I got this mortgage pre-approved, but now you had to show up to the closing table with, about $80,000-90,000 in cash, and you have to sign all this paperwork, right? This big pile of paperwork, which today I've been signing probably 40 times, because I've done 40 deals and probably another 10 or 15 refinances, or probably 50 mortgages for sure over the last 20 years. And you just get a big paper pile, you sign it, right? But it's your first one. It's like, oh my God, this looks really intimidating,
Overwhelming. Yeah.
Totally. And personal guarantees. And if you don't pay, you're gonna take your house away and take you're gonna come after you personally. It's like, oh my God, this is really stressful. So
There
yeah,
was a moment of clarity in mine
I,
too. The first week I was like, oh my God. I mean, what have I done here? What if I can't make the mortgage? Yeah, it's stressful.
Right. And then the first week I owned the building, and then there was some problems in the parking lot, and I think 2 units were vacant, and the property manager said, look, I need 20 grand to fix the units and pave the parking lot. I said, well, I don't have 20,000. He said, well, that's not my problem. Go find it somewhere, right? So you had to borrow someone's line of credit, and so it is often very tight and very stressful, especially the first months, right? And I've done a few mentorship arrangements where I help people get over that hump, because the first one is the hardest. It's a bit like having sex as a teenager. It's the first time you don't know what you're doing. It's very stressful.
Well, and what you just said too, you go into it with no reserve fund. We're not thinking this. I mean, we're scraping by, we're borrowing all the money from family and friends just to close on the bloody thing. Right. Now, like I'm actually doing my deals. I do like 7.5% of the price in a reserve fund. I think you probably do 5 to 7, something similar to that.
Yeah, absolutely. And because usually the first year, even or sometimes the first year or two, you're often negative cash flow, because you inherit a building which in almost any circumstances has deficiencies, right? Some are minor and some are major. So I call them warts. So you become like a wart meister. You got to manage the warts, right? Because it's an older building, sometimes 30, 40, sometimes 50 years old. In Ontario, sometimes 80 years old. And all these older buildings have issues: roof leaks, old windows, old fridges, old carpets, bad tenants. And to clean all that up takes time and money usually, right?
Well, yeah, and on top of that, I mean, on most buildings, you probably have $50,000 in closing costs once you paid for all your reports, your legal, to set everything up. So I believe you refer to that as the J curve. You're already starting in the negatives. So I mean, if you're down 5% right off the bat, you know your investment has to make 7.5 just to get back to zero.
Yeah,
so that's just if you bought the building yourself.
And therefore, it's not a short-term flipping game. I mean, sometimes you get lucky, you buy it really cheap, and you flip it out in a year and make money. But in almost all circumstances, you got to be prepared to hold, because real estate is a high transaction cost business, right? I mean, unlike the stock market, you go online and click, and for $9.95 you can buy 1,000 Tesla shares, right? But you blow $1 million on that if you want. Or today, actually, the stock split 3-1, so today is not as much anymore. 1,000 shares is now only 300,000. But still, it's $10 to buy them all. Versus you buy a building worth $1 million, as you said, there's legal fees, there's mortgage commitment, there's 2 legal fees, your lawyer and the bank's lawyer. There's mortgage commitment fees to the broker. There's reports, appraisals, engineering reports, building condition reports. Plus, there's usually some work to be done immediately, like fix the parking lot or change the boiler or whatever might be required. So you got to
and the cash flow is a myth, because people think you're going to cash flow right off the bat, right? I see these pro formas. My experience, I've owned 11 buildings now, and none of them have cash flowed. It's taken a full 5 years to stabilize. You know, it's a dream, because like everything you just said, the stuff always happens. Like you blow hot water tanks, you have to do a roof or a boiler. You know, this with an older building, this is part of the game.
Right. Yeah, and so you got to plan at least a 5-year hold, and maybe today in a slightly higher mortgage environment, and you know, in the BC, for example, now there's fairly high property transfer taxes, right? 2% or more sometimes, because the building if it's over 2 million is more. The government has to hand out, right? There's PST and GST on certain items. Yeah, so you got to be prepared to hold at least 5 years, and maybe ideally 10, and then usually come out okay. I mean, unless now we hit a recession, we had some bumps on the road where we just decided not to sell because the value actually was lower than what we paid for. That does happen. You know, Alberta is a bit more cyclical than perhaps British Columbia. Ontario also had a good run, and I think we're going to see a bit of a market reset here the next year or two, because people paid stupid prices in 2020 and 2021. I think we're going to see a bit more moderation here.
I agree, especially on the residential side. I mean, the multifamilies didn't drop a whole lot, but the residential just took off.
Well, we haven't seen the cap rate reset yet, because now mortgage rate, even a CMHC mortgage today is 4% probably.
Yeah.
And a year ago it was 1.5%. So
we just did one. We just got a rate of like 4.25 on a refinance.
Yeah, and I did one a year ago. I paid 1.46%, and that's it's a year ago. There's a big change, right?
Thomas has a building in Calgary we're going to talk about near the end that he has a smoking rate of like 1.5. So I want to talk now about the golden years in Alberta. So we mentioned Alberta. So let's say from 2000 to 2005. So you got into syndication. You started raising capital from investors. So in 2004, I was one of those investors. I invested $25,000. We bought Lexington Manor, which was a 49 unit, I believe, on 124th Street. Yeah, I didn't have a clue what I was doing. My wife thought I was loco. What the hell? You're going to lose all this money. Who is this guy? He doesn't even speak English. And you know what? 4 years later, I got a check for almost $90,000 out of $25,000. So tell me about those first few deals. You know, you mentioned CMHC going really high leverage, 85 loan to value. You know, sometimes, you know, it would be a value add, which would be known as a BRRRR today, where you would get a short-term loan and, you know, top it up like, you know, 75% loan to value, and then get a 15% second at really high rates. But you'd still make incredible returns, because the rents were going up really high in Edmonton at the time, and values were just going off the charts. So 2000 to 2005, what were those years like?
I mean, it probably ended 2007. I'd say 2008. That doesn't a peak happened, right? Probably there was 7-8 good years. So this building in Lexington is one example. We bought it for 1.9 million. It was 39 units, so about 50 a door.
39, right? Yeah.
Low 50s a door, concrete building, elevator, but only 1 bedrooms. And we sold it in 2008, I believe, or 7, for 3.9 million, so doubled roughly. But because you're leveraged, right? We had, I think, a 15% down mortgage. So we had a $1.5 million mortgage. We did a refi in between. In a rising market, leverage is in your favor. So you put down 400,000-500,000, and the rest is mortgaged, and you double the building value. I mean, you get 300-400% return on your money. I did that on several deals in the 2000s to 2007, right? But of course, it works also on the reverse. If in the market from 07 to 2010 went down, then it went up again from 2010 to 2015, quite a bit, not as much, and it went down from 2015 to 2020, and now we've seen that boom market again. Not as heavy, because oil and gas, due to our federal government ineptitude and climate cult, they don't want to have massive investment in oil and gas, and we saw that with the German chancellor just in town here the other day. They want to push hydrogen, right? I mean, they could have built a bunch of LNG terminals on the east coast or the west coast and had ships ready to go to Europe, but guess what? We didn't do that, right? It was all.
Well, yeah, we'll definitely have a Canadian political discussion in another call, because it's just kind of.
But still, Alberta is doing okay. It's doing pretty well.
Yeah.
And house prices have gone up a bit, not nearly as much as Vancouver or Toronto. And as an average person, you can still buy a house, right? I mean, our son lives there. He lives in Edmonton. He has an average house that's probably worth about $500,000. I mean, that house would cost you $2 million in Vancouver or Burnaby. It's just an average house, nothing special. Double garage, 4 bedrooms, maybe 2,000 square feet. It's just an average box, right?
Yeah.
But an average person can still afford that, and they build quite a few rentals as well. The rents are relatively inexpensive as well in Alberta. But we're seeing now tightening. And we've seen rents going up finally after 5 years of hanging in by a thread.
Hanging on by a thread is exactly, and in Saskatchewan it was even worse. I mean, I sailed through 20% vacancy 2017, and now we're raising rents. We can do it twice a year in Saskatchewan, so it's significantly better. So noticing the buildings that you have here, Thomas, that you bought in that time period, the golden years, the one that you still have is Windsor Estates.
Yes.
What is so special about that building, and what have you been able to accomplish with that one over the years? Have you been refinancing it?
What's special? I don't know. What's special? It's 120 units, which is unusual. Anything over 100 units is extremely rare. All of a sudden, because I bought the building in 2004. All of a sudden, realtors phoned me out of the blue, say, "Oh, Mr. Beyer, can I buy you lunch here in town? Can I show you some buildings?" Because that year there was only 2 sales over 100 units, and I bought one of them, right?
Boom, instant credibility. Yeah.
So all of a sudden, and we paid then $4.5 million for the building, so about 40 a door. Today the building's worth probably 12, maybe 100 a door, 12 million plus or minus, right? And I've done 2 refinances in between and bought a bunch of investors out. I bought that building with about 20 investors. There's still 5 left. So I bought 15 out over the years, and I basically do an annual valuation. I said, well, if I sold a building today, I could get X. I got closing costs, I got mortgage penalties, I got cash in the bank. So net, we would have X dollars as net value of the company, and therefore divided by number of shares. Your shares are worth whatever, right? You paid $1, now they're worth $1.20, $1.50, $1.85. And you want to get out at $1.85 or whatever the value happened to be that year. And some people say, "Yeah, sounds good. I'm going to take $1.85 and I'm going to get out." So I did. So
does that mean the investors that are left, did they now get a larger slice of the pie, even though they didn't get any cash out? Do they now own more of the building?
Yeah, because you reduce the number of shares, right?
Right.
So I raised 850. I had 850,000 shares. And it was a 50-50 deal. So I do take no fees up front, no management fees, but I take half. So I have 850,000 shares, and then the investor have 850,000 shares, right? And then over the years, we reduced the 850 down to maybe $200,000, something like that. So today I own about 80% of the building, and the people who are still there, they own a bigger share of the building. Plus, we have now about another $1 million of investments in that company. Another number of private investments, including pre-IPO companies and REITs, as well as private equity, land development deals or construction deals with other companies. I'm just an investor now, or the company's an investor.
Right.
We're trying to diversify.
So basically, then you didn't put any money into this deal, and now you own almost 80% of it, just gradually over time.
Correct.
Fantastic. I must admit, I shamelessly copied your JV model. I did 6 joint ventures myself, very shamelessly. I did very similar. I went 60-40 split on mine. Like you, I also didn't take fees. And I'm finding out later now that these deals, I've had some of these deals for 8 or 9 years now, and I'm realizing, man, I really needed to eat in between. I didn't have any bloody money.
Correct.
So your next deal comes along, College Plaza in Edmonton. Now, your fundraising model changed dramatically at that point.
Correct.
So this is where we went into limited partnerships. What made you decide to go to the LP from that point of a model that was very successful leading up to that point?
Well, again, up to that point, I took no fees, took a higher equity stake. And I also realized, like you did, obviously, that you want to make some money, you gotta sell something, right? And I realized whether it makes sense to hold. And if you look at mutual funds, there's usually upfront fees, or the private equity, the hedge fund model is usually 2% fee and 20% upside. That's sort of a classic hedge fund model, 2% a year of the equity, which if you leave at 3-to-1, that's about 0.5% of the gross asset value.
Right.
So I ended up taking a 0.5% asset management fee, and still do that to this day, of the asset value, and you can fairly easily ascertain what's the value of the building, at any one point in time. I mean, you get an appraisal, or you talk to 2 or 3 realtors, within probably 1 or 2% what is the building worth today, right? You wouldn't say it's worth 8 million, it's worth only 5. Maybe you say it's 5.2, but maybe it's only 5.1. But you can be very precise, and then you get an appraisal every so often to ascertain that it is in fact worth 5.2 million. And then you take a fee on that. And usually now we take an upfront fee as well, because, as you know, real estate is very upfront heavy, not just transaction cost-wise, but also work-wise. Most of the work is upfront. Finding the building. For every building you buy, there's probably 3 or 4 you actually seriously consider and look at and write offers on. And there's another 5 or 6 or 8 you actually have considered but don't write offers on, because for some reason the price was not right or the building too crappy. But there's a lot of time you spend just finding the one building, and then even once you've written an offer, multiple iterations, sometimes falls apart. Maybe you rewrite the offer 3 months later at different terms, or you try to get a mortgage and you couldn't get one, go to the next bank. And so that takes sometimes 6 months, sometimes 12 months just to close one building, right? And you spend a lot of cycles. And sometimes you just don't buy it, actually, because for whatever reason, you can't get the financing, or you find the roof is leaking. You want to have price reduction of the building, and the seller says, no, I'm not selling it to you for 100 a door. I want 110 a door, and you say, no, it's not worth 110 a door, and then you walk away, right? There's a lot of no deal situations too, where the seller says it has to be here, and the buyer says it has to be here, and there's a gap, and you can't bridge it. That happens. So you gotta count for all that. So it's appropriate to take an acquisition fee. Plus, as you go bigger, you need to pay other people to raise money. So yes. once you go beyond your friends and family and close business associates, you are basically selling securities now. And in Canada and in the US, there is so-called exemptions to the prospectus requirements. So that the whole market is called the exempt market, because it's exempt from prospectus. But nevertheless, you have to adhere to the security legislation, which differs slightly by province. But by and large, they require you to file certain paperwork. And one is called an offering memorandum, which is a sort of a short version of a prospectus, where you describe in great detail what you want to do, how much you pay for the building, what are your costs, what are your projected operating costs, how much money you want to raise, what does it cost to raise the money. And you put that all on a piece of paper, a document that's easily 40, 50 pages. And then you raise money. And today, now they changed that rule maybe 6, 7 years ago. Now you need an exempt market dealer as well, who is a licensed fundraising company, and they have to file paperwork, and they have to make sure that it's all being done properly. So the fundraising now takes A, more time, and B, is more costly.
So this isn't exactly a model for your first multifamily project.
No, but that's the model.
You're looking at probably buying multiple buildings to set up an LP to have this kind of engine behind it.
No, you don't need multiple buildings, but you need probably a certain minimum size, because no one wants to help you raise $200,000, right? If you say, look, help me raise $2 million, and I pay you 6%, then all of a sudden you find some people, right? Yeah. But that also, of course, lowers the overall return, because in the end, guess what? Who's paying for all these expenses? In the end, it's the investor who puts the money up, right? And at some point, deals don't make sense anymore, because if you take a lot of fees up front and pay all the fundraisers, often the deals become too skinny. So that's another issue right now, that if the market is too skinny, deals don't make sense anymore. And now you find a lot of construction deals out there, which are a lot more risky, right? But we had to do that model since about 2005. We did my first LP. We did offer memorandums, because now we went to the public at large and put out websites and ads. And if you go beyond 50 people, anyway, you got to file it with the Security Commission. You have to make known to the Security Commission who are these investors who put up, let's say, $30,000 or $100,000 or $80,000. You got to file that with the Security Commission. And that's also.
And I think they're getting more and more. I think they're clamping down more and more. I mean, we've had a lot of these LPs, like, I won't mention names on here, but you and I know many of them. You just have to go on my rain space. Thomas has probably got 15,000 posts on there. And if you just go search for limited partnership, Thomas has a bunch of posts on limited partnership. I know you were a staunch advocate of low fees going in, as low as reasonably possible. Yeah. So I know on some of these I'm seeing today, it's once you add up all these fees, it really doesn't matter if the investor makes money. They've made all their money up front. I mean, if they're taking 30% of the fees, that deal has to make a 40% return just to get back to zero. Yeah, and like that could happen years down the road, right? So
totally, yeah. So I mean, obviously looked at not just my own OMs, other people's OMs, and most of the OMs you can search, and there's a search box, right? You type in certain keywords. I always type in fees immediately, and you see all the line items where the word fee or fees is mentioned, and you see what they're taking: 1% here, 2% there, 8% there, 20% there. I was like, whoa! And again, no one wants to work for free. I get that, but it has to be reasonable, right? It's like if you buy shoes, the shoe store has to make money, and the car company who sells you cars to make money. But at some point, you say, look, this is unreasonable. I'm not buying this car. It's too. The fees are too high. I mean, the fees are buried usually, because you buy a car for 50 grand. The dealer makes about 20%, so they buy the car for 40 and sell it to you for 50. And that's what they live on, But
yeah, you really got to do your homework. And how important is not just the structure of how it's set up, but the track record of the syndicator?
Well, I mean, certainly it matters, right? I think it matters that the guy who's doing the deal has some experience in the field, because I mean, I have done apartment buildings, and I've now done quite a few mobile home parks, which is somewhat similar to multifamily. But I haven't done office, for example. I haven't done industrial. I haven't done hotels, and they all make sense too. I think there's nothing wrong with buying a hotel with 80 people and syndicating a hotel and renting it and fixing it up. But I'm not a hotel guy, right? So I wouldn't syndicate a hotel deal, because I have no experience in that space,
Yeah, the more you try to be good at everything, the more you're crappy at everything.
Yeah,
I wanted to ask you, what's that?
You can't be in many markets either, because I've been in Western Canada. I've done well in Texas. I should have, in hindsight, probably done more in Texas. Especially 2010 to 2020 was really boom time in Texas, especially with Trump in power from 2016 to 2020. It did really well, right? We should have, in hindsight, sold everything in Alberta and bought a lot more in Texas. I would have done a lot more, right? But I didn't. So
how do you feel on the American market today? I was going to segue into that, but I know you did really well on I believe it was the Parks of Denton. I know that was bought that in 2007. It was a very tumultuous time. We had some challenges with the mortgage, like we did with many buildings, a lot of vacancies, a lot of turnover. You just hung on by the hair of your chinny chin. But eventually that deal turned out okay, right? And tell me maybe a little bit more about that deal, and what do you think of the market today? We see a lot of these syndicators leaving Canada now and going into the States. Is it better than Canada? What should people be looking at?
Well, first of all, the US is not one market, right? It really differs by state, and even within a state, like even Texas. I mean, Texas is as big as Canada. It's like 32, 33 million people. The Dallas Metroplex is like 10 million people, right? It's a huge market. So you can't buy the US, because Florida is very different than Tennessee, than Utah, than Texas or California, right? You got to specialize in a submarket. We bought a building in north of Dallas in Denton for 13.2 million with 300 units, huge site, 13 acres site, multiple parking lots, gym, pretty rundown building, but we fixed it up. We sold it for 25 million, almost 10 years later, right? So
Wow.
we made really good money there, but the mortgage we had was crap. We had a 7% mortgage and a 13% second mortgage for almost 10 years.
Oh boy.
While the interest rates were falling, right, throughout the time. But we ended up selling at a good price. And maybe in hindsight, I should have kept it, because today we sold for about 80 a door, just low 80s. Today, maybe worth 100 a door. Maybe today it's worth 30 million, right? But
So I'm also adding in the currency factor too, because I know in 2007 we had a really strong Canadian dollar. I can't remember what it was. It was maybe $1.10. So when you sold it, was the Canadian dollar lower? Did you get an extra lift because of the exchange as well?
No, it was more or less the same. But if you had bought in 2010, you could buy, it was at par, right? And then by 2020 it was 80 cents again. You might have made a lift just on the currency, right?
Right.
I think today the US market is somewhat better in that you have more inventory. It's a much bigger market. So you go to markets like Memphis, for example. I'm looking at some deals in Memphis and some other not such big towns like Dallas or Houston. You can find some deals in smaller markets. But again, you gotta work with a local partner who knows what he's doing, right? Because I can probably fly to Memphis and spend 2 weeks on the ground and get and discern of building A is better than building B and building C. But if I've not been in Memphis, but I could discern that. But I have a partner there who we might do a deal, we might not, we'll see. But I think you got to be selective as well, where you buy, what you buy, and the numbers have to make sense. And I think some prices are coming down now because, again, interest rates have gone up, and people are paying 200,000 a door for all the buildings. At some point, wonder, that makes no sense to me, because he can build brand new, at scale, at much lower cost than in Canada. The regulatory overhead is not as big, and in the warmer climates, you don't have deep infrastructure like Alberta. You got to have the pipes 2 meters in the ground. In Texas, 30 centimeters in the ground, or Arizona, right? It's just so it's cheaper to build, and everything at scale. You buy air conditioning units or fridges or drywall per unit is much cheaper than here, and you get cheaper labor, Mexican labor often. You can probably build the whole thing for 150,000 a unit, plus some land costs. So often it makes no sense to buy all the buildings at a premium. So I think you got to be selective. So I think one cannot say it's generally better. I think there's just maybe it's a bigger market, and therefore there's more opportunity. Because the issue in Western Canada right now is there's such little choice, basically, right?
Yeah.
There's very little for sale. REITs own a lot of large buildings, they're not for sale, and there's a lot of junk for sale, which are often overpriced, right? 18-suiters, 12 plexes, 24 plexes.
Yeah, and you see some of the larger players now, like Avenue and Main Street, they're going into those smaller markets and buying up those smaller buildings where they previously might not have done this.
Yeah, because they can't find anything in the big markets. That's right.
Yeah. So on to just generic investing. Like a lot of people think when you invest in real estate, it's just a matter of putting in my money, my green dollars. But in the book, you talk about the green dollars, the red dollars, and the blue dollars.
Right.
Do you want to talk a little bit more about that and why it's not as simple as just putting in money and getting a return on real estate?
Okay. So if you're an investor, what you do is you write a check, right?
Yes.
And you're expecting a return for that, which you should, of course. But if you're the operator, you're the owner of the building, or the future owner, the syndicator, the active partner, whatever you want to call it, you also get a mortgage usually, right? I call that the red money, because you're negative, and you borrow usually between 2 to 4 to 1 of the equity, right? Because most real estate is bought with at least a 50% mortgage. So most REITs, even large REITs like Boardwalk or RioCan, they would have about a 50% mortgage on their buildings. Once you're a smaller player, you usually go up maybe as high as 75, 80%. And the bank wants to make a return on that, right? They lend you money, and they say, well, we need money on that. And plus, you have obviously time and effort involved. So you, the syndicator, I call it the blue money, you want to make some money too on your time invested, right? Because often I invest
Yeah.
money in my own deals too. I want a return on my money, the checker, right? But I also want some return on my time and expertise. And obviously, I know a lot more today than 20 years ago. You know, even you are gray hair now. You know more than you did 10 years ago, right? And so you make less mistakes. So you want some reward for that, right? It's like a hairdresser. You go to a hairdresser, they don't cut your hair for free, right? They it's $20 or
Well, I see that in these some of these burrs, these value adds, hey, I can buy this building at 110 a door. It needs 10,000 a door work, so I'm going to pay 100. Well, you didn't get paid anything for going through the work of doing it all, right? Your time is worth something, So I really love the blue dollar analogy. So I want to talk about fractional ownership. Now, I teach education courses now on my 18 years of multifamily. I don't have the experience that you do, but I've learned a lot from you, over the past years. But fractional ownership has now become important. I understand you're also a passive investor. So we do our due diligence, very similar if you're analyzing other people's deals. But tell me about some fractional ownership. So going in, so for people that maybe don't have $1 million, but they have like 100,000 or something like that, to go into one of these deals. So I understand you do that too. What are some of the real benefits to fractional ownership? And how is that a great way to get into multifamily if you otherwise had no previous exposure to it?
Well, I think what one needs to personally always ask, like, how much time do I want to invest in any one venture? Because if I'm a busy doctor, I'm a dentist, or an accountant, or a lawyer, I have a busy practice. I might have $1 million or $500,000, but I don't have the time to look at 10 buildings and write offers on 4 and buy one, right? Because I have a family, I have a dentist practice, I have other life commitments. So I think one needs to always look at your ability and willingness to spend time on something. It doesn't have to be apartment buildings, whatever you do, right?
Yeah.
And I mean, fractional ownership has been around for 100 years, because you buy any stock of IBM or Tesla or Google or whatever, Facebook, you become a fractional owner of Facebook or Meta, it's called these days. So shares on a publicly traded stock market are fractional ownership, right? You can go online and buy RioCan or Boardwalk or any real estate company or any company has 2,000 choices, but they fluctuate up and down daily for sometimes no real reason. And that similar concept exists obviously in the private equity space, where you become a co-owner with 10 others or 50 others or 2 others, and you co-own a building in this case, or perhaps multiple buildings, which is then managed by another person who may or may not be an investor. And of course, that person who spends all the time and usually, hopefully, has expertise in that space, takes usually some modest fees and some equity stake on the upside, right? Between 20 and 40%, something like that. So usually the lower the fees, the more equity they take, right? And as I said, 2% of equity is reasonable, and maybe 20% of the upside, or you take less fees and you take 30 or 40%. Because again, the person also signs personal guarantees, for example. So in some deals, you might actually be asked to sign a personal guarantee as an investor. Let's say that's four guys, and each put up $250,000, and no, you get $1 million. You buy a building worth $3.5 million. The bank will say, look, each person owns 20%, and I want every person who owns over 10% to sign a personal guarantee. So you could, in theory, lose more than you invested. If for something the building blows up, let's say there's a fire, building burns down, and there's no insurance, all of a sudden, the building is not worth $3.5 million, it's now worth $800,000, which is land value, right? All of a sudden, you actually lose more than you invest if you have a personal guarantee.
Yeah.
And that is usually taken care of by the general partner, or the person behind the general partner, because it might be more than one person. In a limited partnership, that you can't do that, because the limited partners, by the definition, are limited in their maximum loss to their investment. That's why it's called a limited partnership. And there's some flow-through benefits. But you buy a building, it does not have to be a limited partnership or LP. It could be a corporation, or it could be a mutual fund trust, or it could be an undivided interest, like a joint venture, basically. So the LP doesn't mean, 20 or 100 people. It's just a different legal structure. But someone has to put a deal together. Even if you have only 3 guys, and say, hey, look at this house, we want to buy this house, and it's worth $800,000, we can sell it, we can flip it, and make, sell it for $1.2 million. someone has to put a deal together. Someone has to get a mortgage. Someone has to write the offer. Someone has to inspect it. Someone has to find a tenant. Someone has to manage the property manager, right? And that is worth some money or some equity stake or both.
Yes.
Right? You can't just expect 3 guys writing a check and 1 guy doing all the work for free. That doesn't work, right? So you have to define up front who does what, right? And often you get 3 guys and they're all real estate guys and they all have a bit of money. And then they own something, and then one day, like, who does what when? Oh no, I thought you found the property manager. No, I thought you did that. Oh, did you phone the bank? No, I didn't. I thought you did that. Right? So you get this confusion of who does what. And ideally, it's this guy. If I invest in Corey knows what's going on. He has the numbers, he has the books. If I want to know what was the rent collected last month, I phone him and he sends me a statement and say, here it is. Here's my rent collected, here's my expenses, and therefore we have negative cash flow. Okay, fine.
Yeah, I think I think that's critical to have the roles defined like that. Whether you got one guy doing acquisitions, one guy on operations, and maybe perhaps a third guy raising capital, or something else.
Exactly.
Right.
Yeah,
And I think
that's what I did basically on my peak. The peak was probably about 2015. We had about 125 million under management. So I had 1 full-time acquisition guy and 1 full-time fundraiser, plus 2 assistants in terms of accounting and investor relations. So that was probably a 5-person operation at that time. I then decided to not go as big, maybe as Avenue Living or Western Wealth today, or Centurion, all these other firms which done really well. Because to grow from 100 million to, let's say, 500 million or 1 billion, it's a full-time commitment. You got to be on the road 80 hours a week, and I've been doing that for 10 years. But you know what, I don't want to continue to work my ass off for the next 10 years. So I decided to slow down and we started to sell off buildings. So today, I bought up my partners now. So in fact, Scotty just died. I don't know if you know that. He just passed away actually 2 months ago.
No, I didn't know that.
He was only 70 years old. So he was my chief fundraiser, good friend, business partner for 10 years. And he now passed away 2 months ago. His funeral is September 10. Anyway, I bought them out a few years ago now, and now I run the show by myself. I still manage 3 buildings and 3 mobile home parks, but that's not that difficult if you don't actively acquire assets, right? And I could now open another fund, and I go to Memphis, I go to Texas, I could do all that, of course, but that's a major time commitment, right?
Yeah. No, that's some good points. I know probably a lot of people are wondering, why did you get to this point and just stop? But you didn't stop. You're still buying buildings. You have you just bought a building in Kimberley recently.
Yes.
But we're kind of running out of time here, so I want to talk about this Castleview Park. I understand you have actually some investment opportunity in this. This is one that was split between 2 LPs, so it looks like it's between King's Castle and Prism. So these LPs are going to be wrapping up in a few years. So it looks like we have some investors who want to exit out. So there's some opportunity for some new people to slide in. Do you want to tell us a little bit about that deal?
Yeah. So what happens if you do syndications for a while? That you have to say a plan. So we're going to buy this building, we're going to exit in 5 years. Okay, that's the plan.
Yeah.
Well, time rolls around in 5 years. Maybe the market isn't as hot as you thought 5 years ago. The market is maybe flat, and people realize, the money I didn't make as much money as I thought. Maybe I lost the money even. And some people say, look, let's keep going, because once you own the building, the operations costs are much lower, and your financing costs are much lower. You know the building, it's a decent building, decent location, versus you're buying something new. The risk is often much higher because you don't know.
Yes.
Maybe Saskatoon, you maybe did well in Regina, but Saskatoon is new to you, and you might make mistakes because maybe that road you bought on is not a great part of town. So, but you have people who say, look, I told you 5 years I want out. Well, I said, well, I'm not selling the building. You can't get out. Well, I want out. Now you got 20 investors and 2 want to leave, right? And 18 want to continue. What do you do? Right? You can say, well, sorry, you can't get out. And then 2 guys are pissed off, right? Yeah. Or you find people to buy them out. So one good elegant way to exit people who want to get out is to start a new syndication where okay, I got a building, I know it well, I know it's worth, here's the value of an appraisal. And I know there's upside. I know there's upside right now in Calgary, for example, right? We're just starting to see upside after 5 years of sort of flatness to actually decline. And I know the next 3 or 4 years there'll be good upside. And I have an awesome mortgage at 1.46%, locked in till the spring of 2026, so another 3.5 years.
1.146%. 4.6.
Correct.
So we're getting some good pay down on that.
Yeah, so I get about 200 investors in both LPs who own this building across two LPs, and that was maybe a dozen people that want to get out. Usually it's retirement reason, or some people die, there's estate issues, or there's divorces, so people just want to get out, right? And so I say, yeah, so I think, okay, someone's loss is someone's gain. So I will do a smallish syndication for around $1 million to buy about a 20% stake in that building. And we're going to sit on that building and slightly improve it and write the rental up and the mortgage down. And then we sell it in 3.5 years. And so I'll do a syndication with a group called Addy, which is a group out of Vancouver. They do syndications at scale, mainly on the back end. All the software is there to issue certificates, and all the paperwork is quite paper intensive to do syndications. Once you do go beyond 5, 6, 8 people, it's a lot of paperwork involved, security filings and know your client forms and who are you? Are you actually Corey Spurley, and show me your driver's license, all that stuff, right? And they take care of all that back end, so I'll probably use them for that. And I'm showing about a 35 to 45% return in about 3.5 years, right?
So that's target based on so you had an appraisal a few years ago that was significantly higher than the appraisal today. So there's a lot of upside, because at least in my buildings in Edmonton now, we're still way below 2014 rents, and now we're starting to ramp up. So I think in the next 3.5 years, there's tremendous upside. I think this is a tremendous opportunity.
Yeah, exactly. And you have a mortgage locked in, which is significantly lower right now than if I got a refinance today. Because today, as you said, you pay heavy in a low 4% range with CMHC. I just did a refinance on one of my mobile home parks in Rocky Mountain. I was paying 5.5%. But again, mobile home park, but still, it's a commercial mortgage. It's quite a bit higher than it was 2 years ago. It was probably 3.5% 2 years ago, right? So the combination of a really great mortgage with a known building in a decent location in Calgary, with proven upside and proven rent and low vacancies now and going up, right? And I know the building, I know what has to be done, and I know there's no major deficiencies. It's not that the roof is going to leak or the boiler is going to explode next week, So I think it's a good opportunity, and I will come out with some more details. I think that's on our website next year already, but I'll have some more details coming in the next few days.
Okay, I'm going to paste the links to Thomas's site so you can get more information on this. I think it's a fantastic deal. I think Calgary, the vacancy is lower. Calgary's always been, multifamily's always been higher than Edmonton, even though the rents are maybe only slightly higher. And the apartment universe in Calgary is a hell of a lot smaller than Edmonton.
Absolutely.
So deals like this are incredibly rare.
Right, yeah. And the appraisal is about 150-ish a door. And we had an appraisal in, I think it's 2015 at over 180 a door. So I'm looking for only about a 20% upside over the next 3.5 years. So not that, again, we're looking to have an 80% upside, which is unrealistic, but 20%.
No, not even back to where it was. So that's pretty sweet. So is there a minimum investment amount to go into this? Is there a minimum?
I'm working with Addy on that. Addy has 2 offerings. One is where they take very small investors, become a member, and they want to be the next ING, Tangerine, or Wealth Simple of syndications. You put in $50 if you want, $100. But of course, if you put $100 and you make 30%, that's 130. So it makes no difference in your life usually. And then they have an accredited investor program, and the minimum I think is 50,000. But we'll have details in the next few days. I'm working with them right now to hash out the details. The ideal investor would be probably a guy with $100,000, and 10 guys with 100 would be the ideal scenario. But their back end can handle 5,000 investors at $2,000. They can handle that.
This would be a great opportunity for someone who maybe has the 100, 200,000 mark, but they don't quite have enough to get into their own building. They can get their feet wet. They can see I believe in stuff from financial statements, right? So if you read, reports, you can see what was spent on maintenance and property management, and you get a feel before you buy your own building. So then, when they get the returns from this one, they could just spill that over, and then they'll be much better suited and more comfortable to get into their own project versus just going out and trying to find something now, or going together with 3 or 4 partners who also have zero experience. and going out and buying a building, which I've seen as well.
Well, it's also good to see how much work is actually involved, because you
Yes.
realize, you know what, I'm actually glad I just wrote the check and didn't do the deal myself, because you see all the work involved, right? And you don't see it unless you get engaged usually with, and I'm happy to always meet people or show them around in Calgary and you know, do a little property tour. I've done it many times.
Fantastic. So we're kind of wrapping up time here. I really appreciate this call. I know my viewers are going to love this. Just one last question I have for you. Like, let's say just something crazy happened, you were wiped out today. With what you know about multifamily, what would you do? What would be the first thing you would do to get back on your feet?
If I were wiped out today?
Yeah.
Well, you need some cash, obviously, right? What do you mean?
Well, let's say you had zero. Like, would you raise money from partners? Would you try to get into would you try to syndicate a multifamily deal? Would you try to do a rent to own? You know, I don't know. I just kind of
I would probably pick
situation.
I would probably pick a US market like Memphis or some, maybe even Dallas. And probably actually Calgary or Edmonton, because the opportunity is there right now. And buy a modest building, maybe not a 20 suite. I've done too many of those. It's kind of, because the work is the same whether you syndicate 20 units or 40 or 100. The work is exactly the same, and the mortgage paper. So I probably would find a bigger building. The issue is right now it's very tough in Calgary. I've been to find a larger building, let's say 50, 60 units at a decent price where there's a bit of upside. It's very tough, right? There's a lot more choice, I think, in the US. So that's one of probably the benefit in the US is more choice. I would probably go to the US and pick a city. And even if I didn't know the city, but let's say Atlanta is also great upside, or maybe Denver or Salt Lake City, you know. I probably would avoid the coastal because they're heavily rent controlled. But I think you go to Austin, you go to Dallas, you go to Memphis, you go to Atlanta. There's many cities. And once you spend a week or two on the ground, you build a network of realtors. I can probably find a building in Atlanta, as an example. Although I've never been there, which I say at 85 a door, this makes sense, you know. And this one over there at 92 a door, that's not as good. It would take me a few weeks to figure that out, but because I have done it now in many other cities, I can figure that out. That's probably what I would do.
Put together some cash and away you go, and reset. Awesome. Well, thank you very much. I really appreciate the call, Thomas. And like you say, I'll paste those links in the YouTube. Yes, and looking forward to talking with you again real soon.
Okay. Thanks, Corey. Cheers.
Thank you. Cheers.